Welcome to the channel. I'm the Swedish dividend investor. So, today's video is a bit different. We are going to talk about yields and growth. The case for both high yield, low growth, and low yield, high growth, and the case against them. If you want to support me, make sure to like, comment and subscribe. I'm aiming for 1000 subscribers and we're getting very close. With that out of the way, let's jump into the topic for today. So, today's topic is yields, high and low. I want to give you my 5 cents. I'm a bit biased towards high yield, as you should probably know if you are a regular viewer. But I'm going to try to give a nuanced take on both, because there are pros and cons for both. I don't just have high yielders in my portfolio, but I tend to have a minimum of around 3 to 3.5% yield with some decent growth. But let's start with some ultra low yields. Very often in the dividend investing community, whether it be YouTube, Facebook or Reddit, everyone is praising these lower yielding stocks like Lowe's, Walmart, Costco, Apple and Visa. How come? Well, looking at an investment only by the yield is very short-sighted. Often these lower yielding stocks have tremendous growth of their dividend and their share price, bringing us to the pro of investing in lower yields and high growth. Let's have a look at some of them. Starting off with Lowe's. Not only have they been growing their dividend uninterrupted for 62 years, as we can see in their dividend history, but the 10-year compound annual growth rate of the dividend is a massive 16.51%. Let's check Visa. 16 years of consecutive growth, and the growth number, a whopping 17.26% 10-year CAGR. If you have time on your side, maybe you want to enjoy your life to the fullest, but still being able to live on dividends when you are 50 or 60. This could be a great strategy. If everything plays out, your yield on cost will skyrocket and the share price should follow. I thought we should do some calculations to visualize dividend growth. As always, I made a spreadsheet. Anyone shocked? We can see my hypothetical company and a bunch of years. So I will enter a dividend of $1. Before entering the CAGR, in this hypothetical scenario, we buy the stock in 2025, and year 1 represents the year after, so 2026, followed by year 2 or 2027, and so on. Let's go with Visa's insane CAGR of 17%. And there you have it. After 20 years, your dividends would have 20x'd. Now, that's pretty good. And that is also the theory behind buying low yielding stocks with insane growth. That could also mean that the stock would 20x if the market values it with the same yield and expectations 20 years in the future. That is mind-blowing. Now we can look at the price of the business. It's $100. So when you bought it, it had a dividend yield of 1%. Let's say you bought it in 2025, lump sum and only once. Then held it until year 20 in the calculation. You would have a yield on cost of 20.26%. That's impressive. And if the market still values it with a 1% dividend yield, since the expectations are that the growth will continue for another 20 years, we can see the price here. $2,025 and some change per share. Heck, if the expectations are a bit lower, they might value it at a 2% yield. That is still a 10-bagger. Pretty cool, huh? However, and here comes the con part of low yield investing. Projections in the future are nice, and it's very enticing. However, the conservative investor in me screams a bit. The main problem is projecting high growth, not in perpetuity, but for 20 years. I always try to think like this. Can it happen? Of course, anything is possible, but we also need to think, how likely is this to happen? And for that, every individual is different. For me, counting on a 5% CAGR for 20 years from a wonderful business is very likely. 2%. Now that's very conservative. What about 8%? Sure, that could work, if we believe the growth in the first years is super high, only to decrease later in the projection. For me, you might be different. Even using a 17% growth rate for 10 years is still too much. All it takes is for something to slow down that growth and everything falls to pieces. And with a 1% dividend yield, you won't be able to do much as far as reinvesting goes. What I'm trying to say is that this kind of investing is just speculation, or heck, even gambling. If that floats your boat, go ahead. I'm not judging. It's just not my cup of tea. I mean, if you have 10 of these stocks, 6 will probably perform well, 2 will fail and 2 will do exceptionally well. Here's what I would do instead. I would use a lower growth number, and if I'm happy with that, even if the growth might be higher in reality, go for it. Let's punch in 9% CAGR instead. At year 10, your yield on cost would be 2.37%, and at year 20 it would be 5.31%. If you're happy with that and it fits your situation and goals, go for it. Or maybe you go with the moderate yield, moderate growth route. So, if we enter a price of $20 with $1 in dividend, that's a 5% initial yield, and we go for 5% growth. Sure, the dividend takes 15 years to double, but the income is higher, giving you more shares when you reinvest, and you're not hoping for miracles, just a slow and steady paced growth. You will still have a respectable 12.99% yield on cost after 20 years. That's not too shabby. But you do you. I will surely miss out on some rocket ships along the way. Let's do one more example. Let's take the S&P 500. Now, I get that the returns from the S&P 500, or SPY, is the benchmark. This is the market people talk about. Again, I'm fine if you want to grow your wealth by simply compounding it through appreciation. But counting on S&P 500 as a dividend investment is kind of wrong in my eyes. So if we roll with the around 1% yield, that's about the yield from SPY, so a price of 100 and dividends of $1. These are just numbers for the calculation and not the price of the S&P. The average growth from SPY is 7%. That's pretty good, until you realize you started with a 1% yield. That's my opinion. Yours might differ. So, what does that mean in the future? First off, the yield on cost is 3.73% after 20 years. Ooh. Now, for the price. The historical dividend yield has been between 3 and 5%. But since the corporate world is shifting more towards tech, let's lowball it and go for 2.5%, giving us a price of $149.16 20 years in the future. Ouch. Let's say the market is still happy with a 1% dividend at that time. Now we have a bit higher price of $372. 1.5% yield, $248. Not looking good here. What I'm trying to say is you don't buy the S&P 500 for the dividend. You buy it for the appreciation. For one final example, let's do some numbers in a dividend reinvestment calculator. So we are going to choose portfolio as investment type. Quarterly distributions, DRIP 140k starting principal. That's my portfolio size. 12k annual contribution, about what I can save if I lowball it. For simplicity's sake, let's go for a 15% tax rate. Initial dividend yield 1%, 17% CAGR of both the dividend and the share price. And let's go with 20 years invested. Ending balance of almost 5.5 million. A total return of 1,339%. Average annual return of 14.26%. Annual dividend income of $54,899.91 and a yield on cost of 12.63%. Now, I could get by very well with 55k a year for now, but 20 years in the future, I doubt it. Sure, I could sell $1 million worth of stock if the market hasn't crashed and buy high yielders for another 100k per year in income, but that's a lot of ifs here. And this is just me playing with numbers. Don't take any of this too seriously. Now we flip the script. Let's talk about high yield and low growth. This is more my cup of tea. Now, for my personal situation, I can save pretty aggressively, and I'm aiming for being able to choose when, if, and how I will work in a not too distant future. It could take 3 years in the best case, 5 to 6 years if everything keeps chugging along, or 10 years in the worst case. My aim is to have a pretty high yield with a lower amount invested. So for me, high current income beats high income maybe 20 years in the future. Remember, I'm biased here, so you should maybe take this with a fistful of salt. So what are the pros to high yield and low growth? The obvious answer is high current income, at the expense of lower growth in retirement or when you are using the money. Another pro is the ability to reinvest the high income during market crashes. I touched on it in a video talking about BDCs, but even if I get a 40% cut on a 10% yielding stock, that's still a 6% dividend yield. Buying even higher yields, since when the share price goes down, the yield goes up. Now, this is a simplification, but I hope you get my point. You could reinvest the dividends from lower yielders as well, but the raw dollar amount will be lower, giving you less buying power, unless you're very wealthy. What are the cons of high yielders? Well, often there's slow growth or no growth. If you own a stock with 10% dividend yield and a growth of 1%, and the inflation is around 2 to 3%, you're losing buying power in the future. Then there is volatility, since people deem high yield to be high risk. In times of crisis, they usually get punished very hard. For me, that's not a problem. I embrace volatility, since those times are often the best times to buy. There is also an elevated risk, sometimes, since the high yield stocks operates in sectors very sensitive to economic conditions. Let's see an example of the high yield and low growth. We enter a CAGR of 1% and a price of 10 with $1 in dividends. Now, that doesn't look that impressive. 22% growth in total of the dividend, a yield on cost of 12.19%, and if the market wants a 10% yield 20 years in the future, the price could be $12.19. However, if reinvested, the numbers will be pretty good. And of course, dividends can be cut, both a tiny bit and massively, but they can also grow faster. Let's look at the reinvestment calculator and let's keep it the same. But we change the initial yield to 10% with 1% growth of the dividend but 0 growth of the share price. And sure, I wouldn't be as rich, only $1.5 million in value and a total return of 318% with an annual return of 7.42%. But that annual income of 202k is pretty mind-blowing, and a yield on cost of 48.9%, with the value of the portfolio coming from 1.42 million in dividends. But we do have a problem here. Inflation. I thought about a workaround for this. Let's say I have a portfolio with an average 10% yield on cost, and I want to withdraw the dividends for living expenses. I could simply overshoot my monthly needs. So let's say I could live off $2,000 per month. If I wait until I get $2,200 or $2,400 per month, I could use the excess cash to reinvest and create even more income, aka a small growth. Using the reinvestment calculator, We're just going to use the small excess of income. I've gone for $200 per month. That's an annual savings rate of $2,400. That would kick out 17.6k 20 years in the future. What about $400 per month? That would give me 35k extra income at year 20. Taking the numbers from before with my current portfolio size and going with 5 years invested, we can see I would hit over 30k in annual income per year after 5 years. Now, that would mean I would need a 10% average yield on my portfolio, hence why I gave a different timeline for my FIRE goal. So, there's a lot of ways I could reach my FIRE, a mix of both high and moderate yield, or shifting into high yields when I start to reach my goal. I don't think I'll ever have a total portfolio yield of 10%. Maybe it will take 7 years with a 7% yielding portfolio. One thing I do love about higher yields is the tangible returns. Let's say you want to start a business. Do you start a business with the sole purpose of selling that in the future and not collecting any money or just a tiny amount each year? In my case, since I do have a business, I would say no. I started my business to make a living, collect dividends and maybe sell it in the future. But once I have enough customers and employees, my business would become a money machine. Like, it's the difference between buying a house with the sole purpose to speculate you will be able to sell it at a higher price in the future, and buying a house for rental use, collecting monthly rent and hopefully some price appreciation along the way, and maybe sell the house for a profit in the future. If you buy no yield or very low yield, the real money is made when you sell in a distant future. Of course, that may not always be the case, but I hope you get my point. So, to summarize it, for my goals, financial independence in under 10 years, high yield makes the most sense. But if you're under 25 and patient, high growth will probably win in the long run. So, there you have my thoughts on different yields and growth. There is a case for both. It just depends on what kind of investor you are, your goals, and at what time horizon you would want to reach your goals. I hope it gave you some food for thought. If you enjoyed this, make sure to like, comment and subscribe for more dividend and income investing content. I'm the Swedish Dividend Investor, and I will see you in the next one. Stay smart, stay patient and keep stacking those dividends. Ha det gött!